What if I told you that the future of crypto will not be decided by retail investors, but by governments, intelligence officers, billionaires, and the biggest banks in the world? Welcome back to We Are Cosmic. If you're new here, this channel is where we break down crypto, digital assets, and financial power shifts at an expert level, but in simple English that anyone can understand. No hype, no noise, just clear analysis. Today, we're reacting to powerful statements from former CIA officer Andrew Bustamante and also from Eric Trump about Bitcoin, tokenization, and the future of digital assets. And let me tell you, when intelligence insiders and political power families start talking about blockchain seriously, you need to pay attention. Let's start with Andrew Bustamante. He makes a very important point about decentralized cryptocurrencies like Bitcoin. His argument is simple: Bitcoin only becomes useful if people actually adopt it in daily life. If stores accept it, if ATMs support it, if you can easily convert it. Otherwise, it becomes more of a speculative asset than a functional currency. That's a powerful statement because many crypto investors emotionally believe Bitcoin will replace the US dollar tomorrow. But Andrew is looking at this from a government and institutional lens. Governments care about control, they care about taxation, they care about transaction monitoring, they care about monetary policy. A fully decentralized system works against those incentives. And this is where the conversation becomes serious. Andrew explains that governments are much more likely to support centralized digital currencies, what we call CBDCs or central bank digital currencies. These are blockchain-based currencies, but controlled by governments. Countries like China are already experimenting with digital yuan systems. Europe is discussing digital euro frameworks. Why? Because governments can control supply, they can mint and burn, they can track transactions, they can prevent counterfeiting, they can earn transaction fees. That's power. Now compare that to Bitcoin. No government controls it. No central authority can change its supply. No one can reverse transactions. From a freedom perspective, that's beautiful. From a government perspective, that's uncomfortable. Andrew even brings up counterfeiting. Think about it. The US dollar still faces counterfeit operations. Entire agencies work to stop fake money printing. But a CBDC, that's cryptographically secured. You can't just print it in a basement. That's attractive to governments. Now here's where the tension begins. Andrew says Bitcoin may never replace the US dollar because the dollar has something Bitcoin does not: full government backing. The US dollar is supported by multiple institutions, military strength, taxation power, and global trade systems. Bitcoin's value depends entirely on belief and adoption. And here's the uncomfortable truth. If global adoption disappeared tomorrow, Bitcoin's price could theoretically go to zero. Now, before the Bitcoin maximalists get emotional, this is not anti-Bitcoin. This is strategic thinking. Bitcoin may be digital gold, a store of value, a hedge, but replacing sovereign currency, that's a different battlefield. And then Andrew makes another point: scalability. Can 1 billion people realistically use Bitcoin for daily transactions? The base layer struggles with speed. Lightning Network exists, yes, but mass adoption at government scale, that's still uncertain. This is where the conversation shifts toward utility-driven altcoins. Because when we talk about replacing SWIFT systems, cross-border payments, settlement layers, liquidity bridges, now we're entering institutional territory. Bitcoin is powerful, but it may not be the infrastructure layer governments want. And that is where tokenization and enterprise blockchain come into play. So here's the real question I want you thinking about. Is crypto's future truly decentralized and anti-institution? Or is it institutional adoption through controlled blockchain infrastructure? Because the answer to that question determines where trillions of dollars will flow. And on this channel, we don't guess. Andrew Bustamante made something very clear. He sees Bitcoin more as digital gold than as a global payment system. And honestly, from an institutional point of view, that makes sense. Bitcoin was created to remove the middleman. It was created to operate outside government control. That was the original philosophy. Decentralization, freedom, peer-to-peer money. But here's where things get complicated. Governments and large banks do not operate on ideology. They operate on incentives. If something removes their ability to earn, monitor, and control capital flows, they will either regulate it, compete with it, or build their own version of it. And that is exactly what we are seeing. Andrew talks about altcoins that have strategic and utility value. He specifically mentions assets like XRP, Solana, HBAR, Ethereum, and Cardano. Now, this is where the conversation shifts from speculation to infrastructure. These networks are not just stores of value, they are programmable platforms. They are settlement layers. They are designed for smart contracts, tokenization, interoperability, and cross-border settlement. When institutions talk about replacing SWIFT, the global cross-border payment messaging system, they are not talking about Bitcoin. They are talking about fast, scalable ledgers that can move value in seconds at low cost with compliance integration. That's a completely different use case. Take XRP, for example. Its core thesis revolves around liquidity and cross-border settlement. That's attractive to banks. Ethereum dominates smart contracts and tokenized finance. Solana focuses on speed and throughput. Hedera positions itself around enterprise-grade governance. Cardano emphasizes academic research and formal verification. Each of these networks is competing to become infrastructure. And infrastructure is where real power lives. Now here's the irony Andrew touches on, and it's important. Crypto was supposed to remove the middleman, but if banks integrate blockchain into their systems, then you may still be using blockchain without realizing it. You might send money through your banking app, and behind the scenes, a blockchain network settles that transaction, but you don't see it. That creates a strange situation, because from a technical perspective, blockchain wins, but from a philosophical perspective, decentralization might lose. Andrew raises a concern that if full decentralization takes over too fast, large banks could struggle. But here's where I disagree slightly. Banks are not weak. They are adaptable. Look at history. When the internet came, banks did not disappear. They went online. When fintech arrived, banks partnered. When mobile payments became popular, banks integrated them. And now with blockchain, we're seeing the same pattern. Institutions are not trying to destroy crypto anymore. They are trying to integrate it. That is a massive shift. 5 years ago, major banks were calling crypto a scam. Now they are building blockchain divisions. That tells you everything you need to know. The idea that crypto can be put back in the box is unrealistic. Too much capital has entered the space. Too many institutions have studied the cost savings. Too many governments are exploring tokenization. The technology is out. And once a technology creates efficiency, it spreads. Now here's the bigger picture. We are not witnessing a battle between Bitcoin and banks. We are witnessing a transition phase. On one side, you have ideological decentralization. On the other side, you have institutional blockchain adoption. And the most likely outcome, a hybrid system. Bitcoin as digital gold, altcoins as infrastructure, governments issuing CBDCs, banks integrating settlement layers, tokenization expanding access to markets. That is not anti-crypto. That is evolution. Now we're entering the part of the crypto conversation that most people don't fully understand, tokenization. This is where Eric Trump comes in with his bold vision. Everything will eventually be tokenized. And when I say everything, I mean real estate, music, art, stocks, commodities, and even complex financial instruments. This isn't just theory. This is already happening in small pockets, and it's accelerating fast. Think about real estate. Traditionally, if you wanted to invest in a building like Trump Tower, only wealthy investors or institutions could participate. You'd need millions to get in. But with tokenization, that changes. Instead of buying the whole building, you could own a fraction of it, maybe even just one token representing a small piece of value. Your fractional ownership could give you a share of rental income or appreciation, just like a regular investor, but now accessible to millions of people worldwide. Eric Trump highlighted this point perfectly. He explained how tokenization opens finance to the crowd. Instead of 7 banks financing a project, tens of millions of people could invest globally. Fans, supporters, and investors alike can participate in opportunities they never had access to before. This is democratization of finance at scale, and it's powered by blockchain technology. The same applies to other markets. Music and entertainment are prime examples. Imagine an artist like Taylor Swift releasing a new album. Instead of selling just CDs or streaming rights, each song could be tokenized. Fans could purchase tokens representing a fraction of the song's revenue or success. As the song becomes more popular, the token value could increase. Essentially, you're creating a microeconomy for digital content. Art and collectibles are another major area. Many people cannot afford multi-million-dollar paintings, sculptures, or rare collectibles. Tokenization allows fractional ownership, letting investors participate in high-value assets without needing millions up front. If the asset appreciates, token holders share the gains proportionally. Even traditional financial markets are seeing tokenization. Stocks, bonds, and commodities are starting to appear as blockchain-based tokens. Banks and fintech platforms are experimenting with this because it reduces costs, increases liquidity, and allows instant settlements. Andrew Bustamante also touched on the institutional side here. While Bitcoin is still mostly a store of value, tokenization adds real-world utility that governments and banks can support. Fractional ownership, smart contracts, and auditable digital assets align with regulatory frameworks, meaning governments are more likely to adopt these systems compared to decentralized, uncontrolled crypto. This is a critical distinction. A tokenized asset isn't just a currency, it's a programmable financial instrument. You can encode rules, revenue sharing, voting rights, or royalties into the token. That's something traditional finance can leverage immediately. The big takeaway is this: tokenization transforms assets into liquid, divisible, and accessible instruments. It creates global financial inclusion. People who never had access to private equity, real estate, or high-value collectibles can now participate. This is why Eric Trump says everything will be tokenized. He sees a future where access to opportunity is no longer limited by geography, wealth, or banking status. And here's the kicker: this is only just starting. Companies, artists, and even governments are experimenting with pilot programs. The infrastructure is being built. Regulatory clarity is slowly emerging. Once mainstream platforms like Morgan Stanley or E-Trade start offering tokenized assets to clients, adoption will accelerate massively. This is why we need to shift our perspective. Crypto is no longer just about Bitcoin speculation. It's about real-world utility, financial democratization, and massive structural changes in global finance. Now let's talk about something crucial for anyone in crypto, and the role of traditional financial institutions. This is where many retail investors misunderstand the market. It's not about whether banks like Bitcoin. It's about how banks are integrating blockchain and crypto into their existing systems to protect and grow their profits. Andrew Bustamante pointed out a very important fact. Institutions have seen how much money they can save using blockchain. Tokenized assets, stablecoins, and bridge assets reduce transaction costs, settlement times, and operational inefficiencies. Banks don't ignore opportunities like this. They adapt, they innovate, and now they're officially embracing crypto infrastructure. Take Morgan Stanley and E-Trade, for example. They are now offering crypto services and allowing customers to custody digital assets. This is huge. For years, Robinhood and fintech startups were the only platforms giving retail investors easy access to crypto. Now, the largest and most traditional financial institutions are entering the game. This signals one thing clearly: regulatory environments are becoming more favorable, and institutions don't want to be left behind. Think about the scale. Banks like Bank of America, Citibank, and JP Morgan are working with dozens of blockchain companies. They are exploring ways to integrate tokenized assets into everyday banking, cross-border payments, and even investment portfolios. These are not small experiments. These are strategic moves that could redefine how money flows globally. But here's the nuance. Banks are careful. They still earn massive profits from traditional systems like SWIFT and correspondent banking networks. If blockchain completely bypassed those systems, banks would lose revenue. That's why many of them adopt a hybrid strategy. Integrate crypto where it's efficient, but maintain control where it's profitable. This is where we see the difference between Bitcoin and institutional blockchain adoption. Bitcoin is decentralized and unpredictable. Banks don't control it, but tokenized platforms like XRP, Ethereum smart contracts, or Solana-based solutions allow banks to leverage blockchain while still staying in the driver's seat. That's why altcoins with utility value are getting more attention from institutions than Bitcoin for transactional purposes. And don't underestimate the political angle. The Trump administration publicly signaled support for crypto innovation, aiming to make the U.S. a crypto capital of the world. That endorsement matters. When government and regulators signal openness, banks accelerate adoption. This reduces friction, creates clearer compliance pathways, and encourages large-scale investment into blockchain infrastructure. The bigger picture: this is not a temporary trend. Crypto and blockchain adoption are being baked into the global financial system. It's happening quietly behind the scenes. Most retail investors are focused on price charts and FOMO trades, but the real shift is structural. Banks integrating blockchain means faster settlements, tokenized assets, and more accessible global finance, all while keeping control over risk and regulation. This shift also highlights another truth. Crypto is no longer just speculative. It is becoming a functional, real-world tool for finance. It allows global access to assets, fractional ownership, and instant transactions, all features banks and regulators can endorse. So, what does this mean for you as an investor? Understanding institutional adoption is critical. If you only focus on Bitcoin price swings, you miss the larger trend. Tokenization, blockchain infrastructure, and integration with legacy systems are the real drivers of long-term growth. Now that we've established how banks and institutions are adopting crypto, let's break down what this means for everyday investors. This is where theory meets practical opportunity, and where most people miss the bigger picture. First, let's understand the power of stablecoins and bridge assets. These are digital assets tied to a stable value, often pegged to the US dollar or other fiat currencies. They allow for fast, low-cost transactions without the volatility of Bitcoin or other altcoins. Banks and fintech platforms are using these as the backbone for tokenized financial products. For retail investors, this means access to global markets that were once exclusive to large institutions. Imagine sending money internationally or investing in tokenized real estate in seconds for a fraction of the cost traditional banks charge. Next, let's talk fractional ownership. Tokenization allows assets like real estate, art, stocks, and even music rights to be divided into smaller pieces. For example, you don't need millions to invest in a skyscraper anymore. You can own a tiny fraction of a property and still benefit from its appreciation or rental income. The same goes for a painting worth hundreds of millions. You can now own a slice of it through a token. This opens access to previously unreachable markets and creates a level playing field for investors worldwide. Then there's the institutional backing aspect. Andrew Bustamante and Eric Trump both highlighted that governments and banks are not ignoring crypto. They are building around it. Institutions are integrating blockchain infrastructure, so you might be using these systems without realizing it. For example, when you make a cross-border payment or invest through a bank's tokenized fund, blockchain is already doing the heavy lifting behind the scenes. You get faster settlements, reduced fees, and secure, auditable transactions. Now, let's be clear about the risks. These opportunities are exciting, but volatility and regulatory uncertainties still exist. Tokenized assets, altcoins, and blockchain-based investments can fluctuate, and not every platform or asset is equally secure. That's why it's important to research the network, its use case, and regulatory compliance before investing. The same rules of traditional investing apply: diversification, understanding your risk appetite, and long-term strategy. Another advantage for investors is access to previously illiquid markets. Tokenization turns slow, complex, or geographically restricted markets into liquid, tradable assets. Want to invest in a private startup halfway across the world? With tokenized equity, it's possible. Want a slice of a famous album's royalties? Tokenization makes it accessible. This increases liquidity and creates multiple ways for investors to participate in markets that were traditionally limited to the wealthy or well-connected. One of the most exciting aspects is financial democratization. Tokenization doesn't just benefit the elite, it empowers underbanked populations globally. People who have never had a bank account can now participate in global finance using blockchain-enabled platforms. This is why Eric Trump emphasizes that everything will be tokenized. It's about making financial tools accessible, equitable, and efficient. Finally, the integration of blockchain into mainstream finance signals structural change, not a passing trend. Retail investors who understand the technology, its applications, and the institutional adoption behind it will have a significant advantage. While Bitcoin may be digital gold, the real growth lies in utility-driven, tokenized systems that power the future of finance. We've covered a lot so far, from Bitcoin's role as digital gold to institutional adoption, fractional ownership, tokenization, and the democratization of finance. Now, let's tie it all together and look at the big picture, what the future of crypto really looks like and what it means for you. First, understand that crypto is no longer just about speculation or price movements. The narrative has shifted. Governments, banks, and major institutions are integrating blockchain into the financial system. This is not a passing fad. It's structural change. We are entering an era where digital assets, tokenization, and programmable finance will become a normal part of everyday transactions. Bitcoin remains the king of digital gold, but its real power is limited to being a store of value. It's decentralized and free from government control, a hedge against inflation, and a secure way to store wealth. However, Bitcoin is unlikely to replace fiat currencies because governments need control over monetary systems, taxation, and regulatory compliance. That's where central bank digital currencies, CBDCs, come in, giving governments secure, auditable digital money that aligns with their financial and policy incentives. Now, the real growth lies in utility driven blockchain networks and tokenized assets. Platforms like XRP, Ethereum, Solana, Cardano, and Hedera are not just currencies, they are infrastructure. They enable cross border settlements, smart contracts, fractional ownership, and tokenization of real world assets. This is where governments and banks are focusing because it adds real world value while maintaining regulatory oversight. Eric Trump's idea that everything will be tokenized is not hyperbole. Real estate, music, art, commodities, and even financial products will increasingly be divided into tokens. This opens access to investors worldwide, increases liquidity, and allows participation in markets that were previously exclusive. It also gives people financial freedom, the ability to invest, trade, or transfer value instantly with lower costs and more transparency. Banks like Morgan Stanley, Bank of America, Citibank, and JP Morgan are already experimenting with these systems. They are embracing tokenized assets because ignoring blockchain would be risky. People are demanding faster, cheaper, and more secure ways to move money. If banks don't adopt, fintech companies will, and traditional institutions could lose market share. This shows that crypto adoption is inevitable, but it will often happen behind the scenes, integrated into systems we already use. For retail investors, the takeaway is clear. Focus on utility, adoption, and real-world integration, not just price speculation. Understanding which networks and assets have practical use cases, government acceptance, and institutional backing is the key to identifying long-term opportunities. Tokenized assets, stablecoins, and smart contract platforms are not just investments, they are building blocks of the future financial system. Finally, remember this: the world of crypto is evolving fast. We're moving from a wild west of speculation into an era of integration, tokenization, and financial accessibility. This is the golden age that Andrew Bustamante and Eric Trump were hinting at, one where technology empowers both individuals and institutions while reshaping global finance. At We Are Cosmic, our goal is to keep you ahead of this wave, focus on education, understanding, and strategy, track institutional adoption, learn which networks solve real problems, and understand tokenization trends. The price of Bitcoin or altcoins will fluctuate, but the structural changes in finance are permanent. So, as the crypto landscape evolves, remember this: it's not about hype. It's about seeing the bigger picture, understanding the incentives of governments and institutions, and positioning yourself to benefit from the revolution in digital finance. This is the future. The question is, will you be ready when it fully arrives?